just all need to be aware of what's going on. That's the most important thing, is to just question the data and know there's a story behind that. Manufacturing, and I've spoken about this quite often, has been in a contraction. And the numbers go back and forth. It looks a little better sometimes, a little worse, but overall it's in a contraction. So that in itself tends to be a leading indicator. Manufacturing is a leading indicator. So we'll see when that will show any signs of improvement, or maybe it'll get worse, but it's definitely been in contraction. So there are a lot of issues going on that signal to us that these numbers, these headlines, these robust looking numbers aren't really what they appear to be. So always look deeper than that. On Twitter, I actually tweeted about how GDP is easy to be manipulated. It's a number. We got to remember GDP is Y equals C plus I plus G plus NX, which basically means consumption, investment, government spending, and net exports. So if you increase the government spending and you decrease some of the imports, you can certainly raise that GDP. But we also have consumption is up. I think I just read that it grew about 4% higher. So we know that US consumers keep spending despite these high prices. And everyone says, oh, the restaurants are busy, people are traveling. So people are still spending. And that's very concerning because we have higher cost of money, higher cost of debt and capital. So these credit card debt are accumulating. So they are getting higher. There's a lot of research out there showing how credit card debt is through the roof. So all I can say is it's definitely increasing. I think there could be a recency bias going on there. Maybe people are assuming that this time period will change. We'll go back to some ZIRP, zero interest rate policy, or easier money. They think that the Fed will pivot. I don't see any way that the Fed is pivoting unless we have a really severe recession. So to me, a rate cut is more of a negative. It means that we're really far off, and maybe the Fed finally realized they made some mistakes, and then now they need to come back down. But to me, I don't foresee any rate cuts anytime soon. I think we still have inflation. Inflation battle is not over. These higher rates are impacting the growth. Now, as you know, higher rates take time to work through the system. Smaller businesses are more affected. They are being refinanced, and we're seeing that with shorter term loans, they're coming in at higher rates, but the larger corporations have until I think 2025. So it's going to take time to work through the system. We'll have to see if by then we'll have lower rates. Not sure. We don't know what's in the future. But for now, people are spending. And the basic point is consumers are accumulating debt. So we have rising debt, not only the government, but consumers as well. Now, some people compare our time period right now to the 1970s. And if that is a valid comparison, then I have to say, the difference is we have much higher debt. So that's even more concerning. So I had a discussion last week with the great economist, Dr. Peter St. Onge, and we talked about that. He compares the 1970s, us to the 1970s, but with higher debt. So it seems like we're bordering on a stagflation, maybe possible depression. I know, sorry, so much doom and gloom there. Anything can change, stay positive. I think we have to just be prudent during this time period. Remaining liquid is very important, and maintaining real assets, gold, metals, gold and silver, but gold is number one when you think of, monetary debasement insurance. We have, and when you have inflation and you have potential for QE in the future with this rising debt. And Bitcoin, don't forget Bitcoin. Bitcoin now rising 37,000. It's the hardest money ever created. Finite supply of 21 million. Very different, and it gets stronger in time. Very important to know that it's actually building stronger network, thermodynamically sound. A great asset, acts differently than the other asset classes. Remember, it's not tied to fiat like the other classes are. It's its own class, and it moves differently. And I do believe that it's demonstrated its strength in this type of time period where we see monetary debasement and inflation We've had purchasing power decrease since the 1950s, and it's been a massive monetary debasement play since 2009. Since GFC, we've had monetary debasement significantly, and it accelerated during COVID when they created, I think, a few $1 trillion. So our money supply, even though it's shrinking at a really fast rate, we were hit like almost close to 9 trillion in the peak. We've come down about 1.1 trillion from that. We're in the 7.8 trillion range now. Pre-COVID, we're about 4 to 5 trillion. So we still have a lot of money in the system. Maybe that's what's contributing to the liquidity that's in the markets right now. Markets are running, they're green right now. We're in about 4,300 range SPX. So we're seeing a lot of growth, technology stocks running up, AI. I do believe AI is the future long term. Multiples are extended, especially when we have margins compressed, lower growth, technology, innovation, automation. Those are all keys to growth in the future. Stay positive, remain liquid, and subscribe to the channel to stay ahead of all the latest. Thanks.